Dollar cost averaging into crypto. Is it actually the best method to invest in cryptocurrency, or are there better methods out there? We're going to look at some of the data around dollar cost averaging and how to go about a DCA strategy, including a step-by-step guide. I'll leave timestamps for everything down in the description. We can look at dollar cost averaging then. And what is DCA? Well, DCA is very simple. You just take the same amount of money and you invest it at regular intervals. So, for example, if you want to invest $10,000 a year, you'll split that up into either 1 month investments, or you can split it up into 52 investments made each week. It's really up to the individual investor in terms of how often they get paid or how regularly they want to invest. As you can see here, just a very simple overview. You take a lump sum or an amount and you invest that exact same amount at regular intervals, either once a month or once a week, or even once every 3 days. It's really up to you. And you get different prices each time, of course. The whole point of DCA is that you're going to buy some more expensive and you're going to buy some cheaper. But over the long term, you're going to get an average price that is very similar to what the average price of that asset traded at over time. And so, as you can see, dollar cost average versus lump sum investing does give you different results. And so let's have a look at whether DCA or lump sum is actually the best. Well, we have a DCA investment right here. So we've invested $500 over these months and we picked up 0.1642 Bitcoin, which at the end in September is worth about $2,504. Now, if we invested all of our $2,500 in May, we actually would have a better performance by the time September comes around. The reason being is that we put all our money in at $15,000 Bitcoin and we missed out these two where we got much higher, a much higher price for the Bitcoin, which is worse for us because we're trying to buy at a lower price. But if you can see, if you invested everything in July, we would have had the worst results because we would have bought everything at this highest price. So we can assume from this that lump sum investing is great if you buy early and buy low. But the danger of lump sum is you're buying at a bad time and getting a bad price. And so dollar cost averaging is an attempt to essentially even out price discrepancies over time, save us from FOMO and save us from trying to time the market. Here's a step-by-step guide on exactly how to dollar cost average then. We just pick our time and we pick our amounts. Now, as you can see here, dollar cost averaging smooths out price discrepancies over time. And so over the last 5 years, if we had dollar cost averaged both Bitcoin, Ethereum, and BNB coin, we would be sitting on some really great profits. However, if we dollar cost average over the last year, as of making this video, we're right at the bottom of a bear market. You can see that we're actually losing. We're actually losing money because we invested some at a higher price and we are dollar cost averaging during the bear market. Now, actually, this is still better than buying everything at the all-time high because Bitcoin is down around 65 or 70% from its all-time high, but we're only down 33%. And so as you can see, it seems to me like dollar cost averaging during bear markets and reducing any potential prices that you paid at the highs might be a good idea. Now you can dollar cost average manually, just pick an amount and a day and stick to it, or you can set up these automatic plans on many exchanges. I'm going to show you on my Binance as it's the one I use the most. I'm going to go to earn here and then auto invest. We can come down and set a specific plan. Now what I'm going to do is choose one of these cryptos. So we'll choose BTC right here, create a plan. And if you put dollars onto Binance, they'll actually directly switch that into a stable coin like BUSD. If you put euros or pounds or another fiat currency on there, you might have to switch that into one of these stable coins, either US dollar tether or BUSD, and then you can set up this plan. Now, something on Binance that happens is that you can actually put these dollars into the savings portion of the exchange, and I think they pay around 6% at the moment as an interest on dollars, and you put that in there, get the interest, and then every week or whatever you want to do, that just puts it right over into the crypto that you want to buy. So in this example, I'm going to choose an amount, let's say $100 in BTC from BUSD, and I'm going to use flexible balance here because that means I can earn interest on the dollars whilst they're in that account, and then it's going to automate the purchase for me. I'm going to do this weekly, and I'm going to repeat it on a Monday. And I can even choose the time, which I'm not going to do for this example. Read and agree to the terms and then confirm. Now that's going to dollar cost average and literally buy $100 worth of Bitcoin every Monday like clockwork. If there are no dollars in the account, it's just not going to do it for me. But that's an easy way to passively invest, and just not have any FOMO or anything like that, and just invest in the crypto that you want to invest in over the long term. What should we keep in mind though about dollar cost averaging? If we are a long-term investor, like 7, 10, 15 years, is dollar cost averaging actually the best method? Well, let's have a look at some data. First thing to assume is that the investment that we're making is going to go up over the long term. Now that means if we dollar cost average into assets that aren't going to be successful, we are literally just pouring good money after bad. I've just got an example here, Bitcoin Satoshi's vision, over the max amount of time, which is last 3 or 4 years, the thing has actually gone down in value. Now, if we look at Bitcoin, which is like a market index, and so the market index usually rises over time, you can see that dollar cost averaging has, for the most part, been going into rising prices over the long term. So is dollar cost averaging actually the best method in this case? Most of the data we have about dollar cost averaging is in relation to the S&P 500, but considering Bitcoin is a market index as well, I believe it will perform in much the same way, which is generally rising over time given enough time. As you can see by these two pieces of information right here, dollar cost averaging does not, for the most part, outperform lump sum investing given an asset or an index that rises generally over time. As you can see, with lump sum investing, if you invest as early as possible and as much as possible at the lowest price possible, that gives you outperformance with an asset that generally rises over time. If we assume dollar cost averaging is going into rising prices, we're actually increasing our average buy price over time, therefore underperforming, just putting all of that money into the market at an earlier date. The easy way of saying this is that the person who makes the most money is the person who buys the most at the lowest price. That makes sense, right? But unfortunately, most of us don't have all of our money at one certain time. And so DCA is pretty much the only thing we can do. As for right here as well, this is in relation to the S&P 500, which is a market that generally rises over time. It's a market index. Over those 20 years, as you can see here, the perfect timing investor delivered the best results. This is the investor that essentially chose the absolute best day each year to invest. That's the price at its lowest for that year, and they outperform everyone else. We're going to take this as a big no because no one can time the market on that day, and so this is absolutely impossible to do. The next one is invest immediately. Again, this makes sense because if we assume that the market, the S&P 500, just goes up generally each year, it actually returns around 8 to 10% a year if you reinvest dividends. We can assume that over a 20-year period, it's actually just best to get your money in the market as soon as possible, because by the end of that year, the probability is that prices will be higher than that. And so investing as early as possible and as much as possible is a good thing. Now you can see dollar cost averaging is actually pretty much the same as this because of some months or days during that year where you get a down day, and that's definitely great to invest in if we are investing in an asset that generally rises over time. Even timing the market poorly is a much, much better strategy than not being invested in a market index that rises generally over time. That's great for the S&P 500, which is a generally rising market index. But what about Bitcoin and crypto, considering how volatile it is? Bitcoin has suffered numerous 70+% drawdowns, which is very painful if you're getting in at the highs. So when is the absolute worst time to invest? Well, it is the previous bull market. That's when you're going to have the most risk of getting a drawdown from your investment. The next worst time to invest would be the previous bull market and so on. But as you can see, if you wait long enough, you actually do just make money from even these bull markets because the market index generally rises over time. The obvious best time to invest is either as early as possible and wait, or during bear market drawdowns. During these periods, you can essentially get better prices for the asset that you want to invest in. Now, this is, of course, the most uncertain time to invest, and there's a lot of FUD out there. But as you can see, if you are dollar cost averaging from here, it's better to either dollar cost average or just immediately buy once a year when you have some funds, including the bear markets, because that is when prices are lower. The data actually shows that dollar cost averaging is not a superior strategy. It only works if you are reducing your entry prices over time or just increasing the nominal amount of your portfolio. So during the Bitcoin cycle, when we have these drawdowns every few years, you can see these are typically the best time to invest in terms of getting the best relative price. Now, the earlier you invest and the lower price that you get, you are going to, in percentage terms, outperform over the long term. But if you are trying to grow your nominal size of your portfolio, you have to keep investing. And the best time to invest is actually during bear markets. Now, because we can't predict the price, people will DCA a dollar cost average during the bear market. That can last anywhere from 3 to 12 months, getting an average price, bringing their average price down if they were actually investing at the times during the bull markets as well. So typically from the data, investing as early as possible at the lowest price possible is actually the best method. But other than that, what you just need to do is invest often in order to be a participant in an index that is growing over time. Given that most of us invest either weekly or monthly from a paycheck, this actually enforces dollar cost averaging on us anyway. And so for most of us, the real question is, what assets will outperform over the investment time horizon that I've got? If you are an investor 7 to 20 years, then the market is going to take care of itself. And the data shows that we should actually invest a lot during bear markets when we can reduce our entry prices. That will give us, in percentage terms, high returns for that money and reduce the cost of our portfolio, even though we're making it nominally bigger. And of course, asset choice. This, over a long enough time horizon, is going to be the thing that makes you outperform, given that we don't have a lump sum to invest at the much earlier date. This also assumes that the asset you're investing in will rise generally over time. Given that Bitcoin is a market index, it might be suggested to do that, even though it's much more volatile than other market indexes like the S&P 500. If you do want a dollar cost average on Binance, I'll leave that link in the description to a deposit bonus. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.